Hey guys, and welcome to the Tabak Business Sales Podcast with Damien and Sam. Today we're going to talk about appraisals of value, valuation, whatever you want to call it. They are different. Essentially, a valuation, when people say I want a valuation, usually that's a paid valuation. It could be from an accounting firm. They have a lot of standards they have to tick off through the Accounting Institute. It's very expensive, and they might call it an indicative valuation or a full-blown valuation. The bulk of what we do at Tabak Business Sales, it's not a valuation. It's the same thing, really, but it's an appraisal of value. And we normally do this before we have a listing with a business owner. So we've met the business owner, we've found out some information, we've got their numbers. We will then provide them with a document, which is an appraisal of value, similar to a real estate agent giving you an appraisal for a property. So that's what we do, and that's what we're going to talk about today. So it is different than an actual valuation per se, and we like to keep our insurers happy, don't we? And so we call them an appraisal of value, which is what they are.
Perfect. Thank you, Sam. And so, where do you start? Well, as much as I'm not an accountant, but I don't mind getting knee-deep into spreadsheets. So the way I tend to do mine, and I know Sam's pretty similar, I just reproduce the last 3 or 4 years' worth of annual reports or financial accounts on a spreadsheet. I'll get the part year data and insert that as well. Then really the key to it is understanding, well, what are genuine add-backs and what need to be allowed for. And so, again, if the owner's putting a lot of petrol in 3 family cars, well, actually, we can justify a $5,000 or $7,000 add-back, particularly with the way the price of gas at the moment. So we can justify that sort of add-back or adjustment. And what we're doing is we're identifying the profit to one working owner. And there's a little expression called an EBP-ITD, earnings before one proprietor, interest, tax and depreciation. And that's what we're doing for most businesses. And if we then say, right, well, now we're going to allow for a general manager on top, that'll give us an EBITDA after we factor in 100K or 80K or 200K or whatever it might be for a GM to run that business. So what is a business valuation? We need to understand the profit, and then we need to apply the multiple. So understanding the profit is the first point. Mm-hmm. So do the spreadsheets, work out the adjustments, what they are, what they should be. And an interesting one here, I've had the odd one where a trades business, they've dropped 100K. Someone defaulted on payment. Well, that's not normal operations. So instead of having one crap year, that 100 goes back on nominally as an adjustment. And we say, well, look, they did the work. Normal trading for that year is still X, Y, and Z. And so those adjustments are pretty important. They're very open. They're not disguised at all, and they reconcile to the financial accounts produced by the accountant. So that's pretty important.
Unfortunately, guys, I know none of you do this, but any cash that you may or may not receive for any jobs that you may or may not do, we can't actually add that to the top line, because then we'd actually be admitting that that's what you're doing. So we don't want to know about it. We know it's there, but we cannot, unfortunately, value the business based on it, or we can't put that in the information memorandum, because it'd probably get you in trouble.
That's
and us.
Right. And so if you as the vendor want to pull the buyer aside and whisper in their ear, hey, you know what, there's another 20 grand a year coming in here, well, that's your call.
It wasn't our idea.
That's your prerogative.
Lucky this isn't being recorded.
So once we do the numbers, we then have to say, well, okay, what sort of multiple should apply to this? And Sam, do you want to maybe have a chat about how we identify what level that multiple could and should be at?
And this is where I think we do what we do really well. When I was talking about valuations from accountants, I've seen some fantastic ones. I've seen some that aren't. What we can provide and what accounting firms can't is market data. Similar to, again, when I mentioned you're selling your property and they'll go through all your suburban recent sales, we can do that with business sales. We've got sort of 1,000 sales going back, front to back nationwide. And so we've got it all. I think Damien's very good at collating all that onto Excel for all of us. He loves the spreadsheet, as he mentioned. So we can actually go, okay, this is a manufacturing businesses. Here's 6 manufacturing businesses that have similar revenue, similar profit, similar assets, and these are the multiples that it's sold for. That market data is really key to valuing the business, because industries have very different multiples. So another part of it is actually weighing up the pros and cons of their specific business, because every business has pros and cons and they have unique parts about them that affect the multiple. That's why the more we can have on that appraisal document of market data of different sales, the better. And then we're going to look at the risk on the business is, okay, that business received a 3 times multiple, for example, but that had a multitude of customers. This business has a reliance on one customer. That's going to reduce that multiple. So it's weighing up the risks, weighing up the good and the bad, and then comparing it with comparable sales to see what multiples they achieved.
Sam, I think that one 4-letter word is really, really critical here, and that word is risk, because that absolutely defines at what level the multiple sits. So when you look at a profit and you say, hey, well, the business makes $500,000, what is the risk associated with that profit? And again, we've talked previously about the Tabak 12-point business analysis that we have and that we use when we're doing appraisals. You've got to go through these lines and, the owner, the staff, the company history, its financial performance, customers, suppliers, regulatory. Is it an ECE or is it a physiotherapy business that relies totally on ACC for their income? So, and there's a bunch more. So we go through these, all of these, and we say, right, well, with each one of those, on a gradient from 1 to 5, what is the risk associated with this? And it's like anything. The lower the risk, the higher the multiple. The higher the risk, the lower the multiple. I mean, we all remember the GFC when finance companies went to the wall and they were doing very, very risky lending. But the interest they were actually paying, the interest rates they were paying did not reflect the risks that were associated with that sort of lending. So what we do is we say, yep, let's interpret that. And to interpret that accurately, a broker needs to really understand the business. They need to have some time with the owner, A, just to get the appraisal done, but B, more importantly, they need to then back that up when they're writing the IM and say, right, I need to really sit down with these people, fully understand this. Have I used an appropriate multiple for the risk that defines it? Because the price isn't the price until you go to market. And if you have to tweak, you have to tweak. So I think, one of the key things really is having that experience and having the as Sam mentioned, the data that you can say, hey, I know that these are the multiples that we'll get. We belong to a company called BizStats, and BizStats produce some really, really good data. It's very high level, but they're good people, and we can even use that. If our data is a bit lacking, and it might be an automotive in parts and important distribution business, let's see what BizStats says. And that's just a nice backup and a reinforcer of the information that we have. And I think, again, by law, if we've got no comparative data, we actually have to disclose. And this is, again, an appraisal of value of a business, as far as the Real Estate Act goes, is no different from an appraisal of value of a house or a farm. And so we have to say, look, we've got limited market data on this. This is what we do have. This is related to it. This is why we've chosen that particular multiple, because of blah, 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 and blah. So having access to that information is absolutely crucial. And it makes our job easier, but it also reinforces how much we need to really get in and understand how that business operates.
And look, another big part that influences multiples is assets. So tangible assets versus intangible assets. I guess a very simple example is if you've got two businesses that both make, say it's $500,000 EBITDA, 500 grand each. One of them is an accounting firm. It has no assets apart from a few desks and computers. The other business is a civil contractor, and it has $2 million worth of 10-ton diggers and trucks. So straight away, just selling that civil contractor business for $2 million, well, that's a 4 times multiple, but that's all assets. Whereas if you look at the accounting firm, if that was at $2 million, that's 4 times, but it's all intangible assets. So two very, very different businesses. You may argue that that civil contractor is worth 1 year of EBITDA, plus the value of those assets, so $2.5 million potentially, maybe not, and that's actually a 5 times multiple. You'd never get that for the accounting firm, which may only be a 2 times or 3 times. So that split between the tangible assets and the intangible assets is really key. It's similar with stock. We've seen some businesses with a huge amount of stock, and we've had to say, unfortunately, you may not get any more than your stock value at cost, because if you put that into a multiple, that's already a 5 times. And the reality is a bank just won't lend you any more, because then you need working capital to buy more stock. So we have to look at the actual business, the industry it's in, the asset, the asset values. Are we using book value? Are we using market value, et cetera, et cetera? And that can have a huge impact on multiples. There's no blanket approach. There's no 3 times everything. It just doesn't work.
Doesn't work that way. A good example, Sam, I've got one sale about to confirm this week, touch wood, where it's been going for 35, 40 years. They've got $1 million plus worth of stock. That makes good money, but there's very little room for the goodwill in there. So, this is a 7-figure sale, and the goodwill is probably going to be no more than a couple of $100,000, which is less than a year's income. But if you try to push it higher, it just doesn't work, because the overall multiple gets too high. It gets out of kilter. And we know with the interest we've had in the business and the feedback that we get from buyers, we are limited in terms of how we can push that goodwill. And the frustration from that we do sometimes get is where a business owner is advised by their next door neighbour or someone who's a business coach or someone, or perhaps their accountant. We're not beating up on accountants because we love accountants, but they've been advised, your business is worth 2.5 times annual profit plus stock plus plant. And then you run those maths on some businesses and it's like it comes out to 7 or 8 times. And it's just a ridiculous figure that is meaningless. But the vendor has had the seed sown in their head. And when we tell them the reality, they don't like us. No one likes hearing bad news. It's don't shoot the messenger, but the messenger sometimes is just, we're occasionally we're cannon fodder, but we can't not tell the truth.
No,
we have to tell people how it is and how we believe it to be. And
I had an irrigation business down south, a very large operation, and we gave an appraisal of value for it. Had a lot of stock, but it was a cracking business. I think it was, I'm not sure if it was an accountant or a business coach again, or a valuer, they said, valued the business. And, a multiple is the invert of a capitalization rate, which is your yield, your return. So currently the multiple was so ridiculous because they had gone profit plus stock plus assets that it worked out about a 12% return on investment. And I said, okay, so if you've got $7 million, are you going to buy this business for a 12% return, which has got so many moving parts? It's agri, so it fluctuates year on year. If it's a very wet year, it's going to be quiet, et cetera, et cetera. You've got 40 staff, you've got importing, or would you just whack that money in a bank and get, at the time, it was sort of, getting sort of 6-7% and go to sleep and not worry about it, and you're just earning it, or put it in a term deposit. Yeah. And they'd never thought of it that way. Yeah. But it's so simple. It's like, why in heck would you buy this business with so much risk involved for a tiny bit more than whacking into a bank? And you've got to just look at it realistically. And I think some people get caught up in the weeds and don't actually take a step back and go, hang on a minute, let's be honest here, what are we actually trying to do? So
that's an 8.5 times multiple.
Yeah.
So, yeah. Cool. Same. So, Sam, as we come to a close of this particular episode, what are perhaps some common pitfalls? And you've just talked about one,
yes,
which is an overcapitalised business,
yes, exactly,
not actually stepping back, looking at the wood for the trees, yes, and saying, no, that value doesn't make sense. What about some other ones?
I think it's, as I did mention it again before, we probably cover most of them, but it is comparing apples with apples and not apples with oranges or pears, making sure if you are using market data, and we're very fortunate we have a lot of market data so we can justify our multiples and our values, but we are seeing a lot of appraisals or valuations coming, and they're just saying low range 2.1, high range 3.1 times. And it's like, that's great, it's a fantastic range, but where are you getting that from? You need to have comparable sales, you need to compare the multiples with other businesses, otherwise you're just clutching numbers, and quite often they're charging the poor business owner a few grand for the privilege. So you really do need to make sure that you're comparing apples with apples when it comes to providing that multiple.
Yep, okay. I guess in closing, there's a couple of biggies for me. One we've mentioned before, which is the stock, and just make sure that what you're trying to get paid for is good, live, saleable stock. That's pretty important. But the other key one, and sometimes it's ignored a little bit, is, how critical is the owner to the business? You've talked about it earlier, Sam, about, can the owner go overseas for 4 weeks and the business can operate? Owners often will downplay their importance to the business, not because they want to be duplicitous. They know what they know. They're not really putting themselves in a buyer's shoes, coming into this business fresh and understanding fully of actually how much, what sort of knowledge is required here. So, we have to try and factor in, hey, is the owner a rocket scientist, or are they a control freak? I mean that nicely, so everything's delegated through them, or have they actually really delegated and decentralized a lot of the decision making so the business operates really, really well? If too much is connected with the owner, they have to realise that part of their sale process will be them staying for 3 to 6 months,
handover,
maybe longer, an extended handover, and they won't receive all of the money for that sale until that handover's been appropriately, that's really, really important. So I think that's potentially a common pitfall as well, and we do see that from time to time.
Excellent, yeah. And quite often it's a win-win if the vendor wants to stay on part-time basis. They get a little bit of pocket money. They're handing over, I guess, a lot of that IP and relationships that are up here. But that's going to cost the new owner. They're going to have to pay that wage. So they will then factor that into the profit, which will reduce the value. But again, it's just about how we market the business and how we flag any potential issues or just need for an extended handover.
Cool.
I think
There we go.
us.
That's us.
Short and sweet today.
There's a bit about understanding business valuation and some of the pitfalls.
Yeah, and the most important thing we say to anybody is if anyone has any questions in regards to multiples or what's happening recently, what multiple is a plumber getting, just give us a ring. Whether you're an accountant, whether you're a business owner, we're always happy to help. Share what we've got. We're not going to put things in writing and do that sort of thing, but if you just want to have a chat about what's happening out there, you give us a call. Until next time, that was the Tabak Business Sales Podcast with Damien and Sam.